Hi, I'm Max Keiser. Welcome to the Keiser Report. As gold hits a new all-time high and silver hits a new 30-year high, Portugal needs another 129 billion in bailout. Are there 382 tons of gold that they have in reserve going to be enough to insulate them against the banking terrorist? Let's refer to what Thomas Jefferson said. If the American people ever allow private banks to control the use of their currency, first by inflation and then by deflation, the banks and corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. Stacy Herbert.
Max, that sure sounds like what we see in Europe today. The people are being deprived of all their property and are made homeless. But it also applies, of course, to the United States. Mark Faber, Mr. Bernanke, is a murderer of the middle class.
Yes, that's true. Mark Faber is correct. How did he do it? By lowering interest rates artificially down to near zero. Anyone who's on a retirement, pension plan, etc., or has any kind of savings got wiped out to help the bankers. That was the quid pro quo that Bernanke made with the bankers. I'll murder the middle class. You give me huge bonus money and kudos and let me keep this ridiculously stupid job, chairman of the Federal Counterfeiting Bank.
Well, Mark Faber's quote is, if you print money, everything will go up. And now the money printing doesn't go into housing because we have an oversupply of housing, but it goes into equities and for Mr. Bernanke, unfortunately, into commodities. And this is lifting the cost of living of the median household, of the typical household in the U.S. Mr. Bernanke is a murderer. He's a murderer of the middle class and the working class.
Yeah, it's a sad joke because the point of expanding credit as he did was to try to revive the housing bubble. The housing prices keep going down, but now we see bubbles in food and energy. So not only do people live in housing that's going negative equity, but they're paying more for food and energy, and the result is basically economic, financial death. People are now homeless. Middle class is eviscerated because Bernanke is a fool.
Well, you know, his predecessor, Alan Greenspan, in 1966, speaking of quotes, Max, had this to say, in the absence of the gold standard, there is no way to protect savings from confiscation through inflation. Deficit spending is simply a scheme for the confiscation of wealth. And this is exactly what we've seen. They act as if it's charity, that the low rates are there to help the working class and the middle class to get onto the property ladder, to be able to afford these assets. But you see, from Europe all the way to the United States, all throughout the United States, it's this so-called charity which actually helped murder them financially.
Well, look, Greenspan, when he made those comments, he was also talking about how the Fed, through a monetarist policy, could create a dollar standard that was, quote, as good as gold, which is false. There's nothing as good as gold but gold. And when you give someone like Bernanke or Greenspan or the banks on Wall Street the ability to loan money into existence with no collateral, you're giving somebody the ability to counterfeit money, and the result is inflation and hyperinflation. And of course, Mark Faber is absolutely correct.
You know, all these central bankers are murderers, therefore they're a class of serial killers. And I think Ben Bernanke might be John Wayne Gacy.
Wayne Gacy?
The killer clown.
Really?
Remember, he performed as Pogo the Clown at charitable events and performed for children. And he ended up he was using that as a cover to murder 33 children.
Oh yeah, John Wayne Gacy. He'd show up at the kids' show, right, and he'd start making balloon animals. And meanwhile, he'd be out there murdering the kids in the backyard. This is Ben Bernanke. This is the U.S. dollar. It's absolutely worthless. This is Bernanke's contribution to society. He's simply making, what is this? A credit default swap? What is this, a bailout? What do you call this? This is a catastrophe. This is Bernanke's contribution to monetary policy.
Let's look at something that Zero Hedge found, a correlation that might not prove Mark Faber's assertion. 91.3% correlation between food stamp usage and the S&P, or how wealth effect equals poverty effect. So you see the white line in this chart, that's food stamp usage, the increase in the United States since 2009, and the yellow line is the S&P.
White line. What? Oh yeah, well that's right, there's correlation there because they are creating an artificial rally in stocks that will result in a huge catastrophic 20 to 30% collapse one day, as it does every 6 or 7 or 8 years. And of course, that makes the insiders fabulously wealthy because they make those negative bets like Goldman Sachs does on their own clients. Meanwhile, everyone who has money in the stock market and believes that they're buying something of value, they get wiped out again. And then they need food stamps. Who makes the food stamps? Oh, JP Morgan. They get another payday. Those people are now on food stamps, which is another form of inflation because they're just printing more money. It's money printing. That's what food stamps are all about. They're just increasing the amount of nonsensical phantom confetti, balloon animal paper in the system. It's worthless.
Well, I think that's the point that Zero Hedge is trying to make. Ben Bernanke is printing money. It's QE2, perhaps QE3 coming up. All the money is going into either equities or commodities, driving up the price of food, thus causing more and more people to have to rely on food stamps in America.
Well put.
But now, speaking of the Fed, they're in the following headline. Fed's biggest foreign bank bailout saved U.S. muni bonds. A European bank that received the most Federal Reserve discount window help during the financial crisis also took $381 billion in aid from its home countries and owned subsidiaries implicated in bid rigging that prosecutors say defrauded U.S. taxpayers. So this is Dexia Bank, based in Brussels and Paris, and it borrowed as much as $37 billion from the Fed, with an average daily loan amount of $12.3 billion in the 18 months after Lehman Brothers Holdings collapsed.
If they made this into a film, it would be XXX rated. Because what you've got here are banks inserting collateralized debt obligations and various derivatives into each other's orifice, is plural, in an overlapping manner. Then they lube it up with some of that credit default swaps, thanks to Blythe Masters over there at JP Morgan. And you end up with an unholy orgy. So you don't really know what arm fits to what body, what leg sticking out of what. And it's this ungodly concatenation of corrupt kleptocrats swapping spit with each other and other vital banking fluids in a way that create essentially banking gonorrhea, is what we can say. Dexia Bank is banking gonorrhea, only to be exceeded by JP Morgan, which is the equivalent of banking syphilis.
Well, Max, the subsidiary of Dexia Bank was called Financial Security Assurance, and they're in this headline from October 2008, during this time that they were visiting the Fed discount window. Research update. Financial Security Assurance Incorporated AAA ratings placed on Credit Watch negative. So this is from Standard & Poor's, and they still had the AAA rating on Financial Security Assurance that was at the time engaged in defrauding U.S. taxpayers and receiving money from U.S. taxpayers. They put it on negative watch after just marking down the credit rating for Dexia.
Right, we've mentioned it before. S&P, Standard & Poor's, Moody's, they're part of a syndicate engaged in defrauding the global banking system customers and the taxpayer. Okay, they are committing massive fraud. Moody's, S&P, Fitch, they're financial terrorists.
But again, you know, the AAA rating, and at the time, it was backed by Dexia. The French economy minister is saying that Dexia was 2 days away from bankruptcy. They were bailed out and rescued by the French and Belgium and Luxembourg governments. But they had a AAA rating and were therefore able to borrow at 0% and then lend to these municipalities across America, which are now bankrupt. They have austerity measures forced upon them. All of them are having their pensions, their wealth, their property seized via the currency of these credit default swaps that were created in order to defraud them of their property and wealth.
Go to YouTube, watch this show, rewind the last 20 seconds, and watch it about 2 or 3 times to fully embrace what we're talking about. Please continue.
Well, Dexia is in the headline that I saw this week, and I'm going to press this little Google Translate here to read the headline for you.
Okay.
Dexia bonus werkte even op lachspieren.
Wow, that sounds so sexy.
Dutch?
How was that? Bankrupt in Dutch?
No, well, this is the new Dexia boss, and he's receiving an €800,000 bonus on top of his €1 million salary.
Of
and
course.
Again, this is a state-owned bank. He's a civil servant. He's a public sector worker.
When you're in the mafia and you kill somebody, you get upped. So he's a guy who killed a lot of taxpayers, killed a lot of net worth, so he gets a big bonus because it's a mafia.
Well, he was brought in October of 2008. His name is Pierre Mariani. He's the CEO in the picture on the right. In the foreground is Jean-Luc Dehaene. He's the fat guy, and he's a politician who approved this bonus of 800,000 euros to the banker.
He's waist centimeter challenged.
You couldn't make him with one of those thin balloons for sure.
No, but keep in mind that Dexia and these banks are engaged in this criminal conspiracy. And it's not a conspiracy theory, should be a criminal indictment. I mean, that's the difference. It's not a theory. They're engaged in a massive RICO act, massive fraud, but it's so big. And here's the deal, they say that we were 2 days away from bankruptcy. Well, that's the story with every bank in the world, because according to Basel, which in Switzerland, the regulations for how much cash they're supposed to keep on their balance sheet, it's less than 2%. So every single bank in the world is 2 days away from bankruptcy if all the artificially priced stocks that keep on their books drop in value by 1 or 2%. Then they're all technically bankrupt. That's why there's such a need to do this artificial robotic trading and high-frequency trading on Wall Street to artificially keep prices higher, because if they let the market find its true value of supply and demand, every bank and insurance company in America, in the world, is bankrupt the next day, and all these guys would have to find real jobs. I mean, Jamie Dimon would be in Times Square in the men's room turning tricks, I would imagine.
And finally, bring it back to the beginning. We were talking about Portugal having to receive a massive bailout. Numbers are up to $129 billion. This brings me to the United States. IMF urges U.S. budget include Fannie Freddie cost. So the United States should include in its budget the cost of mortgage loan guarantees and other housing supports, the IMF said on Wednesday in a rare criticism of its biggest shareholder. What do you think this is about, Max?
The IMF is going after the U.S. They've destroyed all these other countries around the world. They've destroyed their credit ratings. They've destroyed Greece. They've destroyed Ireland. They've destroyed all manner of country, north, south, east, and west. And now there's only one place to go left. That's America. And they're going to screw up America. And as a result, America will lose its sovereignty. The U.S. dollar will be rolled up into a global currency. And people are going to pay in America their local, state, federal, and world tax. Get used to it. World tax. All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
When we come back, much more coming your way, so don't go away. All right, welcome back to the Keiser Report. Time now to go to New York and talk with Jim Rickards, Senior Managing Director of Tangent Capital. Jim Rickards, welcome back to the Keiser Report.
Thank you, Max. Thanks for having me.
All right, Jim Rickards. Gold continues to hit all-time new highs. Silver has just surged through a 30-year high. What's going on?
Well, this is going to continue. Obviously, there'll be volatility. It's not going to be a one-way street. Gold will go up and down. I thought the most interesting development was right after the Sendai earthquake. At that time, I said that gold would go down a little bit, and the reason for that is, obviously there was a crash in the Tokyo stock market, and when people would need money for margin calls, so I thought a lot of people would sell gold. Obviously, it was a lousy time to sell Japanese stocks, so you sell gold, get a little cash, meet your margin call. So that was pretty obvious to me, but what was interesting is where gold would find a bid. Obviously, it was going to go down, it was going to go back up again, and the prior lows had been around 1340 or so, and I said, I think it's going to find a stronger bid, and I said it would find a bid at 1390. Sure enough, it went down to 1392, turned on a dime, and went back up again. So that was the drawdown was predictable, but the turnaround at 1392 was a real show of strength. So the other thing I think is fairly well known that in the last 10 years, gold has hit the low for the year prior to May in 9 of the 10 years, and hit the low for the year in February in 6 of the 10 years. So as a result of that, we may have seen the lows for the year already, and it may just be onward and upward.
All right, now you mentioned Japan for a second. I want to go back to 2008. During the liquidity crisis,
Sure.
The crash of 2008, there was an unwinding of things like the carry trade or yen carry trade, and you saw a move into the dollar, and the dollar got a lot of support. I noticed that the recent crisis, you don't see that kind of move into the dollar. So is the dollar no longer the go-to currency in moments of stress? What's happening there?
Well, I think it's relative. In moments of it's called manageable stress, I think that's right. I think people are looking at gold as a currency. I think that's the right way to think about it. I've never thought of gold as an investment or as a commodity. I think of it as money, and so people will go to money. But if we have more extreme stress, something actually worse than the Japanese earthquake, and I'm not talking about natural disasters so much as another, say, escalation of the European sovereign debt crisis, I still think the dollar will be the go-to currency, not because the dollar is so strong, but because it's the least weak of the bunch. I compare it to passengers on the Titanic. When the Titanic was sinking, everybody ran to the back of the ship. That was a flight to quality. Of course, they were all going down together at the end of the day. But I think you'll see occasional dollar strength on, for example, the European sovereign debt crisis, just because there's nowhere else to go. I mean, you can try buying gold, but there's not that much of it around. I mean, you could call J.P. Morgan London, put in an order for 100 tons, they would just sort of laugh at you. I mean, that order can't get executed. That can only be done sort of central bank to central bank. So you really can't get that much gold, and so you have to go somewhere, and people will go to the dollar, even though it's a weak currency.
Right, the U.S. dollar, the leper with the most fingers. Okay, so now in Bank of England, they came out, they kept interest rates unchanged. The ECB is supposed to come out and raise rates, or they did raise rates, I believe, by quarter. This is typically goes against the gold and silver story, the higher rates. But going back to the 70s, of course, precious metals rose throughout the entire period of rising rates. So because the inflation genie was out of the bottle. So the question is,
right,
are they raising rates now? Are they going to catch up? Or is it going to be like the 70s and you see this price appreciation against central banks trying to nibble with their little nibbling quarter point raises here and there?
Well, I think it'll be nibbling. I think the ECB sort of had to do something to sort of maintain what credibility they have left. They've bailed out Ireland, bailed out Greece, now in the process of bailing out Portugal. Who knows what's going to happen to Spain? So the ECB sort of looks a little bit like the Fed, print the money, buy the bonds, keep the whole Ponzi scheme going. So their credibility is on the edge, so to speak. So they had to raise rates. Now the U.S. has a little more of a reserve of goodwill by virtue of being the dominant reserve currency in the world, so they can play this game a little bit longer. Of course, the U.S. loves this. They love to see everyone else raise rates, and the U.S. keep rates low. There's this notion that Bernanke's watching inflation like a hawk, and he's going to keep it at 2%. He said that many times. That's complete nonsense. I mean, Bernanke, if you look at his writings and read between the line of his speeches, what he wants is negative real interest rates. They want to get inflation up around 3-4% and keep interest rates at, in the intermediate sector of the curve 2% or lower, and they're certainly much lower than that right now, so that real rates are actually negative. That encourages borrowing. The fear of inflation will encourage spending. The borrowing will increase the money supply. The spending, combined with the increase in the money supply, will increase velocity, and that'll get the GDP up. That's the plan. I don't think it's going to work, because I think we're in a new sort of, I call it the Keynesian trap, meaning, Keynesian economics was developed to solve the problem of the liquidity trap when people were fearful and wanted to save. So the idea was if people are saving, then governments have to spend to keep the economy going. I think now we've come so far down the government spending route that people look at government spending, and far from viewing it as stimulative, they view it as destructive, maybe even new cause for concern. So people are saving anyway. So you're in this situation where the more they ease, the more average citizens want to save, deleverage, pay down debt, et cetera. So we have this new sort of Keynesian paradox that's actually causing a new liquidity trap. So it's going to end badly, but they can keep the game going for a while longer.
All right, let's roll back here for a second. You covered a lot of material there. I want to ask you about what Bernanke's been doing. In the face of the credit collapse, he came in trying to stimulate things, with the target being to reinflate the housing market or the housing bubble. It seems that has not happened, no matter how much credit or liquidity he's thrown at this. The housing market continues to be weak, and that excess liquidity is going into precious metals and commodities and assets, et cetera. So that policy mix seems to be a huge failure. Why did he miscalculate? How did he miscalculate? What is he missing in this big picture? And is housing going to just continue to be a huge drag?
I think he might have been a little disappointed with the result. It clearly failed. But on the other hand, if you're Bernanke, what else are you going to do? I mean, he has to double down. He has to keep going. He knows the minute he raises interest rates, the minute they tighten monetary conditions, the stock market's going to tank, probably with a lag. There might be sort of 6 months between the tightening and the crash. We've seen that pattern in the past in 1987, for example. So there could be a little bit of a lag there. It won't be instantaneous. But the fact is, he knows that's what's going to happen. So he's got to keep easing. So has it worked so so far? No. And the money printing has showed up, as you said, Max, in commodity inflation, but it's also shown up in hot money inflows in places like Brazil, China, South Korea, Indonesia, Thailand. We're seeing bubbles all over the world. So what's happened is Bernanke wants inflation in the United States. He has not been able to achieve that. What he's created is inflation all over the world. Now, little by little, these other countries are raising rates. They are tightening monetary conditions a little bit to get ahead of inflation. So at that point, with the dollar depreciating, that inflation will come back to the United States. The inflationary chickens will come home to roost, so to speak. And that's actually consistent with what Milton Friedman said. He always said that monetary policy acts with a lag of 12 to 18 months. And QE1 started in 09, and now we're close to 24 months down the road, and we're starting to see some of those signs of inflation here. But and on your point about housing, yes, he absolutely does want to maintain housing asset values for a number of reasons. Number one, the wealth effect. Number two, the ability to borrow against housing. Number three, preventing a banking collapse, because so many of those loans are on the books of the banks, certainly in the commercial sector. And of course, we all know what's going on with Fannie Mae and Freddie Mac. The problem is you have bubble dynamics. This bubble, a lot of people say it started in 02, and it did in some ways. But I would say the bubble really started in the mid-90s with changes in housing policy during the Clinton administration that were continued through the Bush administration. And you look at bubble dynamics. Take the Nikkei, for example. The Nikkei hit 40,000 at the end of 1989. Here it is, was it 22 years later, and they're still 75% below the peak. NASDAQ hit 5,000 in 2000. It was over 5,000 in the year 2000, and that's still 80% below the peak. 11 years later. So these bubbles don't. Once they pop, they tend to go all the way down to below where they started and stay there for a long period of time before they come back. If you apply that analysis to housing, I would say housing still has another 20 to 30% to fall. And then when it gets that low, which would take you back to the 96 levels, it's going to stay there for 10 years. So you're not going to see any pop out of housing. But Bernanke is sort of desperate. He's like, well, okay, maybe I understand that, but what else am I going to do? Should we have another depression right now, or should we have 10 years of no growth? Those are sort of his choices.
Right, so the housing problem goes back a couple of decades. It's a structural problem. The government, through incentives, created a deep bias toward housing. It created distortions. And using the Japan example, this could go on for quite some time. You mentioned that you're not exactly the huge critic of the Fed as some are, because the way you position this, I've heard you speak, in terms of a currency war. The Fed has successfully exported inflation to some degree, and I believe you've said, well, the Fed has won the first battle in this currency war. But I want to move on to quantitative easing for a second, because you spoke recently with Eric King, made some interesting comments. Right. I wanted to get into this a little bit. In other words, people are saying, is there going to be more quantitative easing once this round QE2 expires in June, July, or not? Your point is that the Fed's balance sheet is so huge at this point, just monetizing the interest on the current debt equals perpetual quantitative easing. So can you break that down for us and explain that a little bit?
Sure, and I'm just on your first point, Max. I did say that the Fed won the first round, but I didn't say it as a compliment. I'm a huge critic of the Fed. I don't like the fact that they're destroying the dollar, but they did sort of win a round against China. But kind of going to your point on QE, that's exactly right. And this gets so tied up in the jargon of the Fed. You have to sort of translate from Fed speak to English. They talk about stocks and flows. When they talk about stocks, they mean the size of the balance sheet. When they talk about flows, they mean sort of buying new securities and creating money, sort of flowing the money out into the open market. Now, for 2 years, it's been all about the flow. It's been all about creating new money and putting money out there and buying government securities and building up the balance sheet. Now we're coming to the end of QE2, and there's going to be a lot of hoopla. I expect, unless things get a lot worse, which they may, but unless that happens, I expect there'll be some announcement later in April and maybe some leaks and then a formal announcement in May that QE2 is going to end at the end of June. But the point is the balance sheet has been taken up to approaching $3 trillion at this point. So just the maturing securities, if you just took those and reinvested them in new securities, you would basically be keeping a lid on interest rates. And people don't really understand QE2. QE2 has partly monetized the debt. So as the Treasuries issue new debt, the Fed has been buying it, so they have been monetizing their debt. But that was not the stated purpose of QE or QE2. The stated purpose of QE was to keep interest rates down, particularly QE2 was targeted at the intermediate sector. To keep interest rates down, you don't need to monetize the entire debt. You don't need to buy every new issue of government securities. You only need to have the marginal bid. You only need to buy enough at the margin so you can basically paint the tape or keep the price up, keep interest rates low. And so the question is, how much buying power do they have? And the answer is, if you have a $3 trillion balance sheet with a fairly short maturity structure, you've got hundreds of billions of dollars of buying power, certainly enough to manipulate the market to keep those rates down. So, and a lot of people misunderstood what I was saying. They thought I was saying that the Fed would basically have enough maturing securities to monetize the debt, and that's not what I said, and that's not what I meant. What I said was that they would have enough maturing securities to manipulate the market to keep those interest rates down. So that's what I call perpetual QE. Once you get big enough, the stock is the flow.
Okay, and against all this, of course, the one number, the debt ceiling, keeps rising. Unfortunately, we're kind of running out of time. Jim Rickards, thanks so much again for being on the Keiser Report.
Thank you, Max.
All right, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Jim Rickards. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.